I'm Rich Kleiman, Head of Research and Strategy and Co-CIO for the Americas at LaSalle.
And I'm Chris Langstaff, Head of Research and Strategy for Canada.
Welcome to our discussion of the North America ISA Outlook 2026. We're going to take you through what's shaping the economic and real estate outlook across the US and Canada, and why, in some ways, it still feels like Groundhog Day, a repeat of last year's themes, but with a few key twists. Let's start with the macro picture. Much like last year, we're entering 2026 with cautious optimism. The U.S. economy continues to grow, slightly below trend, but not falling into recession. Volatility in tariff policy kept GDP swinging quarter to quarter, but underlying metrics like job growth and consumer spending were pretty steady, although showing some signs of weakening. Fiscal expansion and the AI investment boom are doing enough to offset the drag from policy uncertainty. The Fed rate cuts late in 2025 should encourage more investment and support growth. But we also have to be realistic. Consumer confidence is weaker, and real wage growth, while still positive, is weakening.
In Canada, things look a bit softer. Trade tensions and tariffs have been a bigger drag here, pulling growth below trend. Confidence, both among businesses and consumers, is subdued as a result. GDP growth is expected to be moderate but positive through 2026, and we anticipate a rebound in 2027 after a new US-Canada trade deal is finalized. Immigration policy has tightened to help relieve pressure on housing markets in Canada. Temporary foreign worker and student admissions will decline about 40% from recent high levels. That means population growth overall is running just under 1% per year, but this remains above several other G7 countries. With interest rates, the Bank of Canada has been more aggressive than the Fed, cutting its policy rate to 2.25% by the end of 2025. Inflation remains sticky, core inflation is just below 3%, but rate cuts are creating a bit more breathing room for households and investors. Let's shift our focus now to demographics and technology. Looking at longer-term forces, demographics are becoming more of a headwind. Like in the US, we are seeing the effects in Canada of an aging population and a cooling in immigration-led growth. But there is a cyclical bright side. As Groundhog Day reminds us, even the longest winters eventually come to an end. Canada will return to steady immigration-driven growth after a reset period in 2026, due to the reduced temporary immigration we mentioned. We do, however, expect a more robust rebound in overall demand in 2027 and beyond.
The U.S. immigration story is a bit more uncertain. Policy is unpredictable, and that creates risk for long-term real estate demand. Then there's AI. There's a lot of discussion of how transformational it could be, with our view being AI will likely drive incremental productivity gains. It'll support economic activity and eventually boost some real estate demand. But we don't see it rewriting the economic playbook overnight. The amount of capital investment is of a magnitude to impact the overall economy, which should also keep construction costs from falling during a period of limited development in traditional sectors. Now, let's turn to the capital markets. If there's one big difference from a year ago, it's in the debt markets. In the US, CMBS and CLO markets have reopened, helping boost lending volume, even though transaction volume remains muted. Refinancing activity is leading the way, with many users choosing to refinance to maintain flexibility and optionality rather than sell at today's prices. And while banks are less active on direct lending, private real estate debt funds are filling the gap, often with bank-backed leverage that expands their lending capacity. This has helped spreads compress, improving borrowing conditions even though base rates remain higher than a few years ago.
And in Canada, we're seeing that the banks and other lenders are fully open to and actively lending in the real estate space, with spreads for good quality commercial properties compressing by about 25 basis points over the last 12 months. However, real estate transaction volumes in Canada in 2025 were below both 2024 and long-term averages. But a relatively low Canadian dollar vis-a-vis the US dollar should attract foreign capital and support a pickup in 2026 and 2027.
Equity flows have been slower to recover, especially for closed-end funds. With limited capital being returned to investors, fundraising remains constrained. There's still dry powder waiting to be deployed, but we see a slow return to a more active transaction market until legacy funds start returning proceeds, which in some cases means recognizing losses. The good news is the denominator effect that weighed on allocations continues to fade. Since late 2022, the S&P 500 is up about 75%, which in combination with declines in real estate values means many institutional investors are now below target allocations. According to the recent Hodes Whale survey, investors are about 90 basis points below target allocations on average. That creates the potential for capital flows to real estate to increase. Capital flows should also be supported by investors having confidence in stabilizing valuations, with yields holding steady since mid-2024. We see this as the early stage of a new investing cycle, one where value can be captured at fair pricing rather than distress level discounts. Total deal volumes are still below normal, about 84% of the 10-year average in the US and a comparable level in Canada. But we expect transaction volume to rise through 2026 and 2027 as confidence builds.
Let's shift now to market fundamentals. In both the US and Canada, we have seen green shoots in office demand, with vacancy rates being lower today than they were a year ago, and we forecast further declines to 2028, helped in part by lower new supply pipelines. The industrial and retail sectors in both the US and Canada are also expected to have lower vacancy in 2028, as shown in the following exhibit.
Digging deeper on sectors, we move from Groundhog Day references to Moneyball references. Like baseball's data revolution depicted in that film, our approach is centered on systematic value assessment with a goal of finding undervalued opportunities others might be missing and underweighting sectors and markets where value looks weaker. Starting with apartments, this sector has been an investor favorite for a while, and in our analysis, spanning over 40 years shows why. Apartment income growth tends to beat inflation over the long term. That's a powerful support for value. We've upgraded our view here. Apartments are now back to fair value or slightly attractive relative to other sectors. Stronger long-term growth is a factor, but improvements in the near-term outlook also help.
In Canada, apartment fundamentals are still solid, though moderating a bit due to higher new supply and lower immigration levels. One nuance: apartments built after 2018 in Ontario are exempt from rent control, so we expect those to outperform within the segment.
Next up, industrial. Due in part to tariff-related uncertainty in 2025, we see a market where net absorption has lagged economic growth. As the economy picks up and with limited new supply, we expect to see improving fundamentals. Availability is projected to fall, which should support more robust rent growth returning. Combined with attractive acquisition pricing, often at or below replacement costs, industrial remains one of our top picks for 2026.
Retail in the US, by contrast, remains the hardest to underwrite. Pricing still assumes more income growth than many properties are likely to deliver. We continue to identify specific opportunities, but they require turning over a lot of stones. Neighborhood grocery anchored formats and certain retail parks with strong tenant mixes may provide those pockets of value, but broadly speaking, retail is still a challenged sector. In Canada, we have seen continued strong performance of grocery anchored retail and best in class super regional malls due to resilient retail sales levels despite a slower economy and, crucially, a lack of new supply.
In office, well, to borrow from Moneyball, when your opponent's making mistakes, don't interrupt them. That's how we see some of today's office activity. To our surprise, it seems like some investors are again overpaying, betting that either low prices automatically mean value or cap rates will someday return to historic levels. We don't think that's a recipe for strong value because high capex needs are still going to be a drag on office returns. To be sure, office fundamentals have stabilized, but we're cautious about the investment outlook, especially for core strategies.
That's similar in Canada. Office demand is improving slowly, but vacancy remains elevated overall. There could be selective value add and opportunistic plays, and AAA best in class offices have attracted interest. But for most core investors, the math still doesn't quite work for most of the office sector.
We're also tracking specialty sectors, areas where we see structural demand and attractive pricing. Affordable housing stands out for its steady cash flow profile. Senior housing benefits from long-term demographics, though operational risk must be managed carefully. And industrial outdoor storage has some of the most compelling characteristics: low capex, a high share of value in land, and limited new supply.
To wrap up, Canada faces near term headwinds: tariffs, softer growth, and tighter immigration, but declining new supply levels should keep fundamentals stable. Lower interest rates and a weaker currency should gradually attract more capital.
And in the US, while growth remains modest, lower rates and an improving debt market set the stage for a slow but steady rebound in transaction activity. The overall message for investors: this is an early cycle environment. We're not at the start of a boom, but rather a foundation building phase where disciplined investing should pay off. Real estate debt should remain broadly available, equity flows are picking up, and income returns continue to anchor performance. Appreciation should turn positive again in both markets in 2026. And looking at relative performance, the valuation gap between real estate and equities suggests real estate is positioned to outperform over the medium term, though timing that turn is a key challenge. That brings us to the end of our North America ISA Outlook 2026 discussion. In our 2026 publication, we also have a global chapter and regional chapters on Europe and Asia. We encourage you to continue watching and reading our other materials as we track the next phase of the real estate cycle.